US stocks have been falling in value recently, with the S&P 500 dipping 6% from its all-time high. Investors are now fearing valuations in the country could be too high considering growth may be slowing down. In fact, the Atlanta Fed's GDP forecast for the US was recently corrected from plus 2.3% down to minus 2.8% for the first quarter of 2025. Not only that, all the talk about tariffs, some of which were imposed on some of its closest trading partners only to then shortly after be removed again, is making it a lot harder for US companies to plan for the future. And since markets dislike uncertainty, US stocks have recently been underperforming compared to stocks from other regions, including Europe. While it's completely normal for different regions to have periods where they over or underperform, I'm noticing a worrying trend in European finance communities. Many Europeans are unhappy with the new US government's approach regarding the Ukraine, NATO, and the threat of potential tariffs on European goods, which, without making this political, is perfectly fine and understandable. However, I've seen an increasing number of local investors that started selling off their ETFs containing US stocks, not just the S&P 500 but even World ETFs, and then investing those funds into ETFs exclusively covering European stocks, or one step further, European defense companies. Now, could this actually be a smart move, and is there something you should change in your own investment portfolio? Let's take a closer look if some of the fears European investors have been having make sense based on the current market environment and compare it to other trends we've seen over the past few years. I'll of course also show you how my own ETF portfolio has been performing in actual numbers due to recent events. Let's just say things have not been pretty. Here's the situation in different markets at the moment. US stocks have been struggling so far in 2025, with the S&P 500 dropping 6% from its highs and US small caps falling over 10% from their peak this year. Meanwhile, European stocks have been on a rally lately, with the Stoxx Europe 600 up over 8% since the start of the year. As for globally diversified ETFs, the Invesco FTSE World is currently down 2.7% in euros in 2025, which was to be expected as US companies still make up around 64% of it based on their market cap, while Europe is currently at 14%. Since that's the main ETF my wife and I buy on a monthly basis, let's see how our shared portfolio has been performing in actual numbers. We're currently down 4.27% or 20,000 euros over the past month alone, and 2.79% since the start of the year. As for how this affects our yearly return since we started investing 8 years ago, that is currently sitting at an average of 10.62% per year since 2017. Okay, so clearly there's some discrepancy in the markets right now, with European stocks finally catching up a bit after having significantly underperformed since the financial crisis in 2008 compared to US only and global stock indices like the all-country world. And if European stocks continue outperforming, this means they'll automatically grow their share in global ETFs, which I would be happy to see as I'm based in Austria myself. Speaking of ETFs, you can find my favorite low-cost brokers in Europe for ETFs linked down below in the description, which is a great way to support me if you'd like to. Alright, now let's go over the reasons some European investors have been changing their investment strategy recently and see if they make sense. The fear of losing ownership of individual US stocks and US stocks within ETFs. Here's the reasoning I hear. The current US administration is out of control and anything could happen. What if they decide that nobody outside of the country is allowed to own US stocks anymore? Just look at what happened to Russian stocks in 2022. As a result, we should only invest into European stocks as those are the safe option long term. Okay, let's just ignore the fact that the EU did something unprecedented by freezing Russian-owned assets and bank accounts in Europe first, and in response to that, Russia then decided to block foreign ownership of its companies. That's all I'm going to say on that front though, as I hope the war ends soon. The US would have too much to lose by restricting ownership of its stocks. It would send its stock prices into free fall and completely destroy investor confidence in the country. Since Americans base a large part of their retirement on stocks, this would make no sense whatsoever, and the United States have zero incentives to ever consider something like this. Now add to that the fact that Trump likes to measure the success of his presidency on how US stocks perform, and you can throw this fear right out the window. Which is to say that switching to a Europe-only portfolio just accomplishes a single thing. You'll only be holding European companies and you'll be fully exposed to whatever happens on this single continent. Which is fine if that's your preferred way to invest, but this is historically unlikely to increase returns nor to lower risk long term compared to investing globally. The same applies to anyone making the argument they should now only invest into ETFs issued by fund providers with European origins like Amundi instead of using Vanguard, Invesco, Spider, etc. All of this completely ignoring that European fund providers like Amundi have a history of merging funds, changing them later on, often to an ESG version nobody asked for, sometimes even increasing fees, or like to exclude specific companies from their ETF because they don't fit their current worldview, even if they're present in the underlying index. I personally feel a lot better holding ETFs by Invesco, Vanguard or Spider long term compared to Amundi, but everyone is of course free to make their own decision. The same goes for the broker you use. There's no reason to believe a Europe-only broker is suddenly a better and safer choice or more aligned with your interests as a European compared to an established, highly profitable broker like Interactive Brokers with its long history simply because they're originally from the US. If you're based in Europe, your ETF shares are still custodied by Interactive Brokers Ireland in its European depository, so there's nothing an originally European broker would be doing better in that sense either. Oh, and let's not forget how often Europe-based brokers don't let you buy a specific ETF because they assume you're unable to read a key information document in English. So if it's not available in your local language like Slovenian or Greek, you're not able to invest. Sorry. You'd be surprised how many brokers do this, including the Giro and to some extent Trade Republic, and it makes no sense. This needs to change as soon as possible. Let's get to reason number 2 I've been reading. We'll show the US, let's support Europe instead. Okay, so let me get this straight. You don't like the US president and some other people that are currently in charge, so you're going to show them by avoiding US stocks and boycotting US goods and services. After all, you now despise everything coming out of a country with a diverse population of 340 million people, a large percentage of which actually have European origins. In fact, you're on your way to throwing out your iPhone and going back to the good old Nokia days right now. I hope you're catching my sarcasm, none of that makes any sense. The only way you would actually be directly supporting the current leadership is by either pushing up the price of the Trump media stock, which is already down 77% from its peak, or the nonsensical Trump meme coin, which is not looking pretty either. But let's not even get into that. Look, there's nothing wrong with you supporting local businesses in Europe, far from it. Just don't start demonizing the entire US population and all of its companies, many of which are industry leading in their fields for a reason, only to then pretend everything is perfect in Europe. It's not. We're making plenty of mistakes ourselves. Now let's get to the latest trend that's all over European finance subreddits, European defense stocks. Here's the logic I've been reading. Since Europe is planning to increase its spending on military defense, these stocks are pretty much guaranteed to perform exceptionally well, right? Reddit is never wrong after all. Not only that, we're once again supporting honest European businesses, yay! Let's just have a quick look at one of the most often mentioned companies in this segment, Rheinmetall, a German arms manufacturer. Its stock price is up 178% over the past 12 months and now has a ridiculously high PE ratio of over 100. To put that into perspective, the current price to earnings ratio for the S&P 500 index in the US, which the same investors are calling highly overvalued, is currently sitting at 26.2. But okay, let's say you somehow managed to buy a diversified basket of European defense stocks. Here's how likely that is going to work out based on some recent trends. Anyone remember the EU's Green Deal investment plan of over 1 trillion euros in 2020? Something like this would lead you to believe a clean energy ETF has to be a no-brainer, right? Well, let's look at the iShares Global Clean Energy with its large fund size of 1.7 billion euros. While it performed well in 2020, the year of this announcement, it has performed horribly ever since. In fact, it is down minus 60% since its inception 18 years ago in 2007. Let that sink in. Or how about Katie Wood's ARK Innovation ETF? I remember that was all the hype a few years ago. Who wouldn't want to invest into disruptive, innovative companies? Sadly, that one is also down minus 65% from its top. Heck, remember when everyone thought nobody's going back to in-person meetings and we're all just going to be using Zoom from now on? Well, didn't quite work out that way either, did it? Look, do whatever you want with your money, just understand that you're a lot more likely to underperform the market long term when jumping on trends like this. Just please make sure you keep emotions out of your investments. Remember when you said you're investing for the long run? Well, long run is at least 5 years, ideally 10 years or more. That's several US presidencies. You're unlikely to like every single one. Are you going to change your investment thesis and strategy every time? Dumping your ETFs for whatever the latest trend is at the time according to Reddit? That is extremely unlikely to work out well compared to just buying and holding on to a globally diversified low-cost ETF strategy long term. So whenever you get caught up in emotions, relax, take a step back and really think things through before making irrational decisions you may regret later on. If this period feels hard for you emotionally, it may be a good idea to stop reading the news on a daily basis and to remember that this too shall pass. And if you're worried because your ETF is down a few percent, I find it useful to zoom out and see what happened after similar dips or corrections in the past. If you'd nonetheless like to increase your exposure to stocks outside the US, which is absolutely fine, the xTrackers MSCI World XUSA could be worth looking at. But if you'd like to add some extra Europe to your portfolio specifically, the Vanguard FTSE Developed Europe and Amundi Stoxx Europe 600 could be solid options, or the xTrackers MSCI Europe Small Cap if you'd like to focus on small cap stocks. As for my wife and I, we like keeping things as simple as possible, so we'll continue buying a single global ETF going forward, the accumulating Invesco FTSE World, no matter what is going on in the markets or what the news headlines are telling us we should be worried about. By the way, you can find my favorite low-cost brokers to buy ETFs in Europe down below in the description, which is a great way to support me if you'd like to. In fact, I recently recorded a detailed guide for my favorite broker, Interactive Brokers, which I recommend watching if you haven't seen it. And don't forget to like and subscribe if you haven't yet. As usual, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.